Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 18 in our series for 2025, and today's date is Friday, June the 13th. First, I'll be talking to therapist, lawyer, mediator and personality expert Bill Eddy, the co-founder and director of innovation at the High Conflict Institute, who will tell us how to stop workplace bullies before they start. And I'll be talking to AMP Capital Chief Economist Shane Oliver about how the market is going in response to Trump's tariffs, Australia's inflation rate, the RBA, and how to fix our low productivity. But first, let's talk to Bill Eddy.
Well, Bill, tell us about bullying in business.
Well, what we see is bullies are actually everywhere, including in business. And in business, they often show up at all levels. So you have employees bullying other employees, you have managers bullying employees, and you may also have business owners bullying some of their other executives as well as people below them. And we see bullies in startups, and especially in startups where being driven, being confident, being self-centered, believing in your stuff regardless of what everybody else thinks are good characteristics for launching a startup, but bad characteristics for maintaining a business. And occasionally you see people do a dramatic escalation of their business and then destruction of their business. So bullies could be anywhere in the business world.
Has it got worse over the last few years?
Well, it's hard to say in business, but in general, bullies have gotten worse. So we see them more in public now. We see them on airplanes. I fly a lot and speak in different cities. And a couple of weeks ago, I was on an airplane and somebody yelled at somebody getting off the plane and says, "Move it, you SOB," only they said the whole thing. And everyone turned around and looked at that person. Well, the guy just got off, didn't react to it, but I've never had that before. And so on the streets, just everywhere, we're seeing more bullies. So whether it's more in business than before is hard to say, but it's certainly present.
Okay, what's causing it?
Well, I think partly the pandemic helped increase this, but I also think our modern technology, especially social media, has shown people images of bullying over and over and over again from around the world. So bullies are becoming role models for what gets attention. And some of the bullies make a lot of money. And so you see, wow, well, that guy made a lot of money by being a bully. Maybe that's what I need to do to make a lot of money. But I think also that social media has helped bullies find each other and encourage each other rather than discouraging each other the way the community standards do. So with social media, anybody can find their group that reinforces them being, nasty instead of saying, hey, you got to be more appropriate if you want to move ahead. So I'd say social media. I think our screens in general, the news on TV, movies, drama, seeing images of bullying gets a lot of attention. And so we're getting shown those images more than ever before. And then people are copying those images.
What's interesting with social media is that social media seems to be a platform for people to promote themselves rather than to communicate. So it's about, look at me, this is what I think, this is what I mean, and that creates a bullying culture, does it not?
I think it reflects a bullying culture and creates a bullying culture. So it's kind of from both ends, because who it attracts are people who have a high level of self-confidence to put themselves out there. And the line between self-confidence and narcissism is pretty gray. And so we often get people who are the most aggressive, most self-centered, very comfortable with, say, social media and putting themselves out there. And people who aren't like that kind of get off. And there's actually a study that was done, and I mention it in my new book, that showed that we aren't all becoming more hostile online, that the people who were already hostile in person are getting more attention and are louder online, and reasonable people drop out of the conversations early on. So it really looks like everybody's screaming at each other.
So it's sort of like reasonable people don't want to have anything to do with it, so they back out.
Right. And so it looks like everybody's doing this, because if you go online, you see all these hostile comments, and it gives a false impression that everybody's becoming more hostile, when in fact the people that put themselves out there often are the more hostile people.
What's interesting in business is how a company can deal with it. And a lot of companies seem to struggle with it.
Right. They're not prepared for this, and society's not prepared for this. And so people often just kind of wish and hope things will settle down and the person will come to their senses. But that's not how bullies work. If you're an adult bully, you've probably been a bully most of your life, because adult bullies don't just start at 25. They more likely start at 5 or 6 and then just kept going, whereas most kids stop. 90% of kids don't do bullying as adults. They get over that as kids. So it's part of their personality, and that's what seems to keep it going.
So businesses struggle with it. So
Yeah.
what should they be doing, and how can they be doing it best?
Yeah, so there's different levels, what coworkers can do and what the organizations can do and what leaders should do. But certainly the theme with bullies is that they don't stop themselves. And I guess that's the point I was getting to. I kind of forgot where I was going with it. But that they don't stop themselves. Therefore, the people around them and the organization need to stop them. And what I found in researching my book is that businesses often wait way too long, that they keep giving more chances, and that these people don't change. And so why keep giving them chances to do more damage to the organization? So I think sooner rather than later, people need to recognize there's a problem here. Now, with our High Conflict Institute, we developed a method called New Ways for Work Coaching, which teaches basic conflict resolution skills in 3 or more coaching sessions. So if we're consulting with a business and they're saying, should we fire this manager or keep this manager? And what I tell them is give them some coaching and see if they can change their high conflict, difficult bullying ways. And maybe half the time coaching does make a difference, and maybe half the time the coaching doesn't make difference, and people just leave or they get fired. So it's give them a chance, but a very short chance. And you'll see, is this a pattern or is this something that can change?
But it's a 50% chance of it actually working.
Yeah, that's what we've seen. And this is anecdotal, so it's not from a study or anything. But from our coaches, they're basically saying, we see some progress with some people, enough that the organization wants to keep them, especially like in high-tech companies where there's specialized knowledge. They don't want to lose those people, but they also have what they call sharp elbows. It's hard to work with them. So if you can smooth off the sharp elbows a little bit, maybe you can get the best out of them without having them harm or push away other people. And an example I like to bring up with that is Steve Jobs with iPhones and iPads and all of that, because he was well known as a bully in the San Francisco Bay Area, the Silicon Valley, and yet his management team was able to set limits on him. And he responded to that. I mean, he picked them in many ways, but they would push back. And he'd say, I'm going to fire this division. There's 200 employees and they got the project wrong, or they're too slow or something. And And one of the management team would say, "Hey, Steve, let's go for a walk. Let's go for a walk." And he liked to go for walks. They go out for a walk and they calm him down. And then he'd come back in and say, "Okay, here's what I want this department to do," instead of firing the department like a bully. So the people around can make a difference.
So what you need is actually a support team if you're in a bullying culture.
Yeah, you need to have restraints coming from somewhere. And if you surround the person with reasonable people who can not take personally what the bully does, then you may be able to really help them succeed.
Are there any particular sectors that are more prone to bullying?
It's hard to say. I think that conflict-oriented professions like law, I'm a lawyer, and I'd say there's a higher incidence of bullies in law. So let's say if the general population has 5 to 10% of people might be bullies, maybe law is 10 to 15%. It's still a minority, but that's who gets a lot of the attention, and people go, "Boy, that guy's a real jerk. Lawyers must be terrible." But it's not. Most lawyers aren't like that. But the bullies are attracted to professions like law because they get to say nasty things about other people, and it's supposedly part of their job. I would say police may have a higher incidence of that because they have power over other people. Military may have higher incidence of that. But again, it's still a small percentage. Other fields, healthcare, ministry, counseling, they're supposed to be caregivers. And yet bullies in those positions can really manipulate people and do a lot of psychological harm. So one thing I think we see is every profession has some of these, and that people tend to protect their own, and that's not a good thing. You shouldn't be protecting the bullies in your profession, or your whole profession gets a bad name.
Well, Bill, it's been fantastic talking to you, and thank you very much for enlightening us.
Thank you, and I hope people go for my book, Our New World of Adult Bullies, How to Spot Them and How to Stop Them. And also, I hope they come to our website, highconflictinstitute.com. So thanks, Leon, for the opportunity to speak with you.
And now let's talk to AMP Capital Chief Economist Shane Oliver.
Well, Shane, what's your assessment of the markets right now?
Well, the good news is that we've seen a strong rebound from the lows back in April. Into those lows, markets had fallen 14% for Aussie shares, global shares, about 18%. US was down about 19%. Since then, we've recovered about 80% of that. In fact, the US and Australian shares are within 3% of all-time highs. So you've seen a nice rebound. Obviously, it's all been driven by the noise around Donald Trump's tariffs. First, the ramp up of tariffs going into and just after so-called Liberation Day, and then his backflips initially for the global reciprocal tariffs, and then China. So that sort of spurred markets to think, it's not going to be as bad as feared. But there's still a bunch of problems lurking out there. The tariffs haven't gone away, even if they stay where they are now. And we get to the end of the 90-day pauses, and there's no increase in tariffs from where they are now, you're still going to have very high tariffs compared to last year. On our calculation, it's around 14% on average going into the US, obviously more on China, less on some other countries. But that's still 5 times higher than it was last year. So it's still going to be a constraint on global growth. Secondly, Donald Trump is still talking about higher tariffs on some countries. That may come up in the next few weeks. We know that some of the deals will take a while to get over the line and may falter. So odds are we'll end up with higher tariffs than we've currently got going into the US. And of course, the bond market in the US, investors generally are starting to worry about the blowout in the US budget deficit, particularly with the tax cuts, the tax cut bills working its way through Congress. And so that's starting to worry investors as well. It was highlighted by the Moody's downgrade of America's credit rating on Friday from AAA to AA1, I think they call it. So the first notch below AAA. So that's basically where Standard & Poor's took it back in 2011. And Fitch took it to in 2023. The only problem is that Moody's, I think, has just provided another reminder that America has this debt problem. Debt is net debt's, I think, about 100% of GDP. Gross debt's about 125%. It's hard to see current budget projections and the potential changes leading to a slowdown in the rate of growth in debt. You're still going to have budget deficits around 6-7% of GDP. So that's starting to become a factor as well, along with the broader issue around a loss of faith in economic management in the US. So I suspect we're still in for a volatile period, and we've had this big rebound, but it wouldn't surprise me if we go through a bit of another pullback over the next few months.
Well, the issue is the respite in tariffs is only temporary. Like the one with China is only 90 days. So we'll see what happens after that.
That's right. That's right. So that's right. The tariff story hasn't gone away by any stretch of the imagination. There's also this perverse effect that if markets rebound and everyone's relaxed again, then Donald Trump might say, okay, well, what's the problem? I'll ramp up the tariff screws again and see what we can do. Because America also needs the revenue here. If they can get revenue out of tariffs, and that means they've got more money for tax cuts in the US and less pressure on the budget deficit. So there's all sorts of balls in the air here, but the tariff issue hasn't gone away by any stretch of the imagination. It's just paused. And it's paused at pretty high levels, 10% on the rest of the world, 30% or on our calculations, actually about 40% on China. And you've got these sectoral tariffs, 25% on autos, steel and aluminium, and more to come in terms of pharmaceuticals. So we're a long way from being out of the woods in terms of the tariffs.
Well, the issue too is inflation. The US, who seems to be rising.
Yeah, we have got some good numbers lately, not too bad up to April, but some would say, well, the tariffs are only just ramping up, so the impact of that is yet to fully show up. The numbers in April were actually quite good, coming in well below expectations and continuing that downtrend in the underlying rate of what they call core inflation. So the CPI core was, I think, 2.8%, which is good news, but it's early days yet on the tariffs. And obviously the Fed is thinking, well, unemployment's 4 point something, very low. We don't have to rush to cut rates. In the meantime, we've got this threat to inflation from tariffs. So let's just wait and see. So they've got no rush by the Fed to cut rates, despite the fact that Trump keeps berating the Fed and Chairperson Jerome Powell.
The impact too is, we've got inflation down here, but what impact will inflation have over here?
Well, I don't see why what goes on in the US will necessarily impact Australia this time around. Obviously, it did back in coming out of the pandemic, but that wasn't so much. That was mainly because of the pandemic effects. We were all affected by the same thing. We had a lockdown, people couldn't spend, and then we come out of the pandemic with lots of money to spend, and at the same time, supply chain had been disrupted. Now we've got this thing where America's in a trade war with the rest of the world, but the rest of the world's only in a trade war with the US, with one of their major trading partners, but not all of them. So that means that other countries aren't imposing tariffs. We're not imposing tariffs on the US, so there's no reason why our prices go up. We, in fact, might actually see lower prices as China diverts and other countries divert more of their product that might have gone to the US to Australia. So you could get cheaper prices for BYDs and a whole bunch of other things, consumer electronic goods and clothing and stuff that might have been destined for the US. So I don't really think it's an issue for Australia. The main issue in Australia is that, well, I think inflation's come down nicely here, but we still have a productivity problem. That productivity growth has been very weak. And when you've got weak productivity growth, the level of wages growth that's consistent with keeping inflation low is a lot lower. The more productivity you can get, the stronger your wages growth can be. And there's obviously concerns around that. We've still got a tight labour market here. Wages growth running in the low threes, but with productivity growth around zero or negative, you could argue that's not consistent with inflation around 2.5%. So that is something that Reserve Bank is worried about and will constrain how much they'll ease rates by. But in a big picture sense, inflation has come down nicely in Australia, enabling the RBA to ease.
But Treasurer Chalmers has said, it will take years to
lift
productivity. He's saying it could take 2 terms to do it.
It could to get productivity up. We noticed that in the 80s that we had a bit of a slump in productivity through the 70s, then Hawke and Keating, and then it was continued by Howard and Costello. They were going for a couple of decades to get productivity up, and ultimately it worked. It certainly worked started to become apparent in the 90s that productivity growth was improving. So it does require a long time before economic reforms aimed at boosting productivity start to bear fruit. And of course, it's unclear that the Labor government, despite their increased political capital with more than 90 seats in the House of Representatives, it's unclear that they're actually going to be embarking on a strong reform program. In fact, I get the impression that they're probably not going to do that. They will call it a strong productivity enhancing reform program, but I think it will mainly be the government doing things that the government can do, like spending more on this and that, as opposed to government getting out of the way by cutting taxes or reforming the tax system or deregulating. And so therefore, I think it's only going to be a partial effort at productivity enhancing reforms, not a full effort. And therefore, getting productivity up may take a long time. There are some distortions in the productivity numbers which suggest they're not quite as bad as they look. Mining productivity has been down because of some new mining projects occurring at a time when mining output is not yet fully up to speed. So that's dragging down mining sector productivity. And when you look at non-mining private sector productivity, it's not too bad. Most of the weakness in productivity is in the public sector. So we've dramatically expanded the healthcare sector, the so-called care economy. It's hard to get productivity gains in those sectors. You can do it, but it's a harder slog than it is, say, in manufacturing. But I think if the government was going to do some things, it would probably look at limiting the growth in government spending, limiting the size of the public sector, freeing up more resources for the private sector, making sure the health system is as productive as possible. Deregulating, less red tape will be a big thing, of course, and of course tax reform. They're the sort of things you really need to do, but it often requires quite a lot of political courage to do those things.
Well, what's interesting though is that you've got in countries like, say, the US and UK and Israel, you've got companies actually investing in technology, which is actually creating productivity. You don't really have that in Australia that much. The investment is very low. And also, I think you're going to need to work, the government will need to work with business and unions to address this productivity issue.
That's right. So to get investment up, you've got to create incentives for business, and the current arrangements don't do that. And in fact, we may be making it worse with the tinkering in the superannuation system and the $3 million super tax. So basically business needs incentive to invest, and we're seeing a bit of that, but not enough. Corporate tax rate is too high. It's at the very high end of the OECD countries. A lot of startups, small businesses, venture capital get some of their capital from SMSF funds, but SMSF funds may have less incentive to have their money in that if there's a 30% tax on unrealised gains in those funds. It makes it very difficult for those SMSF investors to manage those venture capital investments when they're locked away, have to be locked away by definition for many, many years. And then they suddenly find that they might have a big tax bill along the way. And the question is, where do they raise the money from to pay the tax bill if it's on unrealised gains? So there's all sorts of complications around that, but we have been progressively making it harder and harder for business to invest. The labour market has become more regulated, which again acts as a disincentive for companies to invest. So these things really need to be addressed, but at the moment it's hard to see what will trigger that. Historically, it has required some sort of crisis. If you go back to the 1980s, the crisis at the time was obviously the stagflation of the 70s, low productivity growth at the same time, people worrying about their living standards going backwards, not doing so well, and very strong inflation. And then, of course, we had a terms of trade shock in the mid-80s, after which Paul Keating was talking about a banana republic, and that inspired ongoing economic reforms, and then it took on a life of its own. But without that sort of crisis, it's hard to see government doing the things or all of the things that need to be done. And therefore, we might find ourselves locked into a lower productivity world. And that's not a good thing. I think we're not alone in this. Canada has a similar problem. In fact, So you really have to get investment up. But to get investment up, you need to create the right incentive environment for business.
Dude, well, Shane, that's all fascinating. And thank you very much for your time.
Thanks, Leon. Take care.
So what's happening in the news? Well, the global economy is projected to slow sharply this year as President Trump's trade policy disrupts international commerce and increases economic uncertainty, the World Bank said in a report that underscores the toll of America's trade war. Despite the weakening outlook, the global economy is not expected to fall into recession, the World Bank said. However, the trade tension is setting the stage for the weakest decade of growth since the 1960s. Economic development in many of the poorest parts of the world has come to a standstill. Expansion in global output is forecast to slow to 2.3% in 2025, from 2.8% last year, the World Bank said in its Global Economic Prospects report. That is down from the 2.7% growth that it forecast in January. The world economy today is once more running into turbulence. Indemit Gill, chief economist of the World Bank, wrote in the report, without a swift course correction, the harm to living standards could be deep. The country facing the biggest downgrade from the World Bank's projection in January is the United States, which initiated the trade fights. US output is poised to slow to 1.4% this year, from 2.8% in 2024. That is nearly a full percentage point below the January estimate. The rise in trade barriers heightened uncertainty, and the spike in financial market volatility is set to weigh on private consumption in international trade and investment, the World Bank report said. It added that investment was likely to cool due to record high uncertainty, the rise in financing costs, and reduced domestic and external demand. The United States enacted across-the-board 10% tariffs on imports and 50% tariffs on steel and aluminium imports this year. It has also threatened reciprocal tariffs on dozens of trading partners and raised tariffs on Chinese imports to 145% before lowering them to allow for trade negotiations. The tariffs have pushed